longtime CEO of JP Morgan, Jamie Dimon, came out this morning and is warning that panic will overtake the stock market as the U.S. approaches a debt default. Now, on June 1st, that's going to be the X day in which the government runs out of money. Now, they could extend this by shutting down government programs, by laying some people off, by not funding the military. And there's ways they could stretch this out. But by and large, June 1st is the day in which a deal needs to be done. Now, JP Morgan goes into depth on how their stance is around the debt ceiling. And they even say that JP Morgan is preparing for a U.S. default. Keep in mind, a U.S. default has never happened before, but we did get a credit downgrade in 2011 that caused the stock market to drop about 22%. If a downgrade did that, what would a default do? It would be an economic disaster. Even public figures, like you guys know this one, Donald Trump came out yesterday and said Republicans should let the United States default if Democrats do not agree to budget cuts. Whew. That doesn't sound too good. So we're going to get into exactly what JP Morgan is saying here. But most importantly, as you guys see from the headline of this video, the title of this video, Jamie Dimon says a collateral crisis could occur if the debt limit is not raised. And we'll talk about why that is, how that could affect stocks such as AMC, guys. So we're going to get into this. A couple other things here in this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. And if you guys do want to come trade with me live in real time, link down below in the description of this video as well. Now, the headline of this article says Jamie Dimon warns panic will overtake markets as U.S. approaches debt default. The key points. JP Morgan's Chase CEO Jamie Dimon said Thursday that markets will be crippled by panic as the U.S. approaches a possible default on its sovereign debt. Quote, the closer you get to it, you will have panic in the form of stock market volatility and upheaval in treasuries, he said. Such an event would ripple through the financial world, impacting contracts, collateral, and clearinghouses, Dimon said. Let me say that again. Such an event would ripple through the financial world, impacting contracts, collateral, and clearinghouses, Dimon said. An actual default would be potentially catastrophic for the country, Dimon told Bloomberg in a televised interview. Dimon said he expects that the worst-case scenario will be avoided, however, because lawmakers will be forced to respond to growing concern. The closer you get to it, you will have panic in the form of stock market volatility and upheaval in treasuries, he said. So basically what he's saying here is they're not going to act. They're not going to, put their pants and their shoes on and get to a vote on the debt limit until there's a reason to. Until financial conditions are really threatened and they start to see the effects of them not raising the debt limit. And that could be a pull down in the markets. That could be, again, what Jamie Dimon is saying, upheaval in the treasury market. Then they will actually do something about it, or at least try harder to do something about it. Now, Dimon joined a host of business figures and administration officials making dire predictions about the consequences of failing to raise or suspend the U.S. debt limit and allowing the world's largest economy to default on its bonds. Treasury Secretary Janet Yellen has said the idea of the country could default should be unthinkable and would lead to economic disaster. Quote, if it gets to that panic point, people have to react. We've seen that before, Dimon said. But quote, it's a really bad idea because panic becomes something that is not good, he added. It could affect other markets around the world. JP Morgan, the biggest U.S. bank with about $3.7 trillion in assets, has been preparing for the risk of an American default, Dimon said. Such an event would ripple through the financial world, impacting contracts, collateral, clearinghouses, and affect clients definitely around the world, he said. So not good. Not good. The bank's so-called war room has been gathering once weekly, a rate that will shift to daily meetings around May 21st, and then 3 meetings daily after that, he said. Ooh, so they are preparing for something very negative coming after May 21st. That could mean maybe not this next week, but the week after that could be pretty sizable in the markets. And 3 meetings a day would be a lot. He exhorted politicians from both major U.S. parties to compromise and avoid a ruinous outcome. Please negotiate a deal, Diamond said. Now, how does this collateral crisis play into all of this? Well, the government not paying its bills, as they say, not paying out interest on these treasuries, well, that would be a technical default, and we've never defaulted before. So that would affect the credit worthiness of America, and kind of like if you get a better interest rate on your mortgage or a car loan because you have better credit, it would kind of be like everyone's credit going down in America. It would could be pretty bad. Now, worst case scenarios, you could be talking mortgage rates going from 6% to 12 or 15% almost overnight. That would basically shut down the real estate market. That would shut down lending as a whole in America, and you would almost instantly go into a pretty deep recession. Now, collateral crisis, that's interesting because, especially with short positions, there's unlimited risk if you're short in a stock. So there is collateral requirements, there is margin requirements that are put forth to make sure that each party will be able to follow through with what they're trying to do, right? If AMC were to rally and you had a short position, I got to make sure I can get my shares back and you can buy them back 10 times higher or whatever the number is. So I demand collateral. Well, what if the markets go through a violent downward move and quality stocks are cut in half? Let's be dramatic. Let's say Apple gets cut in half and Microsoft and all these other names. Well, I'm going to want more collateral because now what you have given me is worth a lot less. So I'm going to want more collateral. And then you're potentially not going to have the money to give me more collateral. And that could cause a huge jam up where essentially with stocks such as AMC, some of your riskiest positions would have to be closed out upon, right? Because at this point, if America did default, there would be big problems going on, right? So that's the problem. There wouldn't be enough capital to go around if you did have a collateral crisis. Now, the clearinghouses, that's a different story. Who knows what would happen to that, because there's so many different counterparties to everything going on. You got the options market, right? You got the short market where there's shares that are out on loan, where brokerages have shares out on loan everywhere. And when the value drops so much, you're going to be getting margin calls on a massive scale if this debt ceiling were not to be raised. Or in the most likely outcome, debt ceiling does get raised, but like Jamie Dimon says, you're going to need to see the stock market fall. You're going to need to see bond yields increase, aka bond prices fall, before you actually get any kind of deal done. So even it sounds like JP Morgan's base case scenario is that there's going to be a pretty violent downside move in the markets before the government actually reacts, before they actually do get a deal done. And that puts a lot of pressure on especially shorts that are short in AMC, because odds are AMC sure would fall, but probably the stocks that have ran up the most would fall the most as well. And those are the technology names, right? Most of the markets are actually down for 2023. The Russell 2000, the S&P's hardly up. The Russell 2000 is flat on the year, essentially. A lot of stocks have not had such a great 2023 like the 5 to 10 largest companies in the world have. Now, other banks, In the wide-ranging interview, Diamond said he speaks daily to regional bank executives amid concerns sparked by the Silicon Valley Bank collapse in March. Last week, JP Morgan emerged as the winner in the government-brokered auction for First Republic. Regional banks are, quote, quite strong and will have good financial results, but managers are worried because of the bank runs that have taken down 3 firms, he said. I think we have to assume there'll be a little bit more to the regional banking crisis, he said. So even on that note, the regional banking crisis, in JP Morgan's words, doesn't look like it's over. And what he's basically forecasting is panic in the stock market, is stock prices are going to go down quite a bit. And that is a huge, I can't stress this enough, this is a huge problem for shorts that have to put up collateral in their short positions for AMC stock. This could force shorts out of their short positions. That's why Volkswagen short squeeze in 2008. It wasn't necessarily that Porsche bought a substantial stake in Volkswagen and locked up the float necessarily. That happens quite oftenly in the markets. It was because there was virtually no collateral to go around at that time. It had all been exhausted in shorting Volkswagen already. Like, there wasn't collateral to go around. It was the bottom of the markets in October of 2008. You were just screwed once Volkswagen started to squeeze. On top of that, there was, high days to cover. There wasn't a lot of shares outstanding, so that also does play a role. But I think even more importantly, that allowed Volkswagen to get to that level was the fact the markets were in the toilets at that point, right? And it makes people a lot more jumpy to actually cover for good reason. Obviously, if you're not jumpy to cover, then you'll get blown out at the top, like a lot of people did. Let's not take that away. Some people committed, hurt themselves, let's say that, due to the Volkswagen short squeeze alone. Like pretty bad. Look up people that hurt themselves after the Volkswagen short squeeze. You'll see a couple of them, and pretty gruesome. So we're not going to talk about that here really too much in this video, but nonetheless, it causes a lot of problems for shorts. And if JP Morgan's saying we got a problem, well, we got a problem. So ladies and gentlemen, that is going to do it for this video. I did just want to kind of give you guys an update on this collateral crisis and what JP Morgan is saying. On top of that, watch this key level into the close today for AMC, as AMC is only now down 3.5%. $5.21 per share is the 100-day moving average. You gotta stay above that level. I literally cannot stress that enough. That is, or was, the last major resistance level before we broke out above it. Now it's going to serve as strong support. And if we go ahead and look at the low of the day today, that was at $5.19 per share. So you did actually break under that $5.21 area, but now you're finding a lot of support and basically bounce ever since from there, and you really bounce at the $5.21 mark over and over and over again today. So pretty exciting overall. Nonetheless, guys, that is going to do it for this video. Hopefully you guys can see the positives in this video and not just look at the fact that AMC is down 3.5%. You might be down, but AMC is certainly far from being out. So that is it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in another jam-packed video here around 4:30. So you guys enjoy the rest of your day, and I'll see you in the next one.